Hello, my name is Modeste from Greylock Capital Management, and you're watching AFK Insider. My name is Modeste. I'm a director at Greylock Capital. Greylock's a fixed income emerging markets investment fund. We've been around since about 1997, and maybe the portfolio that is now the core of the fund probably began as early as 1994. So the fund invests globally in kind of emerging and frontier markets. So broadly speaking, that's Latin America, Eastern Europe, Asia, and Africa. And we specifically look at the fixed income end of the investment spectrum. So sovereign bonds, corporate bonds, loans, receivables, and certain kind of private debt transactions. During our approach, we really look to maybe kind of 3 to 5 year investments. My role at the fund, I'm an analyst there. I look at specific investments. I cover Africa. Within our Africa portfolio, we have a mix of both sovereign, in fact, probably it's mostly sovereign investments, but there's also a healthy amount of kind of private sector investments as well. I cover Africa, but in some ways the basis of the fund kind of came within from Latin America. And the cycle that we've seen a lot of the BRIC countries, and that's BRIC, Brazil, Russia, India, China, go through is the same one we're seeing Africa going through at present. So if you look back to maybe 1990, 1995, you saw countries like Brazil, India that were in the process of restructuring their defaulted sovereign debt. And you had India, Brazil trading at 4 cents on the dollar. You look at what those countries did, which is, achieve a fair amount of political stability, go through financial sector reforms, strengthen their domestic capital markets, go through a new round of sovereign issuances, and now those countries are trading, north of 100 cents on the dollar. They're very strong investments. They're very highly correlated to the developed world. And we see Africa, and many countries within Africa, is going through a very similar cycle. So if you look at the fact that maybe as of 2000, you maybe had 2 sovereign entities in Africa that had sovereign debt. I think now maybe there are 14. It's still a small number relative to the total number of countries on the continent, but if you look at that within the scope of what's happened just over 10 or 15 years, we see that as a very positive development. So when we look at countries like, for example, Ivory Coast, Zambia, Senegal, Nigeria certainly, Ghana, we see them taking on the same reforms and initiatives that countries like India and Brazil did 10 to 15 to 20 years ago. So we certainly see that opportunity coming for countries like Ghana, where we could look at a healthy sovereign market, a healthy domestic issuance, but then also a healthy corporate sector issuance. So as the government sector strengthens, you would see the corporate sector strengthening as well, and those countries looking, or those entities looking to the international markets for finance. Right now, most of the corporate growth is done with, kind of earnings and shareholder capital. Many of those countries don't really access the private capital markets. So we're looking at sovereign sector development and then corporate sector development in places like, Ivory Coast, Ghana, Senegal, Zambia, we're in Mali looking at investment opportunities there as well. So we really do look in the kind of the frontier end of the spectrum. So in terms of what we're seeing in Africa, I think a phrase you often hear is the development of the middle class. And it's oft repeated, but what it basically means is the middle class in Africa, which was a relatively small section of the population before, is growing rather fast, and they're looking for the same goods and services that you see in other developed parts of the world. And it starts with a very basic demand, so better transportation infrastructure, better telephony, better banking systems, more developed banking systems. So I think the old model, for example, for housing development in many countries, like Ghana, was you saved up a bit of money, started building your house, saved a bit more money, started building it. Maybe 10 or 20 years later, you've got your fully built house that you would occupy. The mortgage market is extremely small in many of these entities. So building up mortgage finance companies is something that we would look at. So I think the cycle that we look at in terms of development might be first to look at the financial services sector, look at the banks, strengthening some of the banks that are there, looking at expanding some of the consumer lending opportunities that some of these banks might offer, consumer credit cards, strengthening credit bureaus, things like that. And then you start to look towards what does the middle class want? So they want, better shopping. I mean, it's very basic, but there's a mall in Ghana. I think it's a Game Supermarkets has as one of the anchor tenants. It's very popular. You can get anything that you would get in any other mall in any other part of the country. And there aren't very many of those opportunities. So I think you can look at very basic very basic opportunities, very simple opportunities to invest in. I don't think you need to get very, say, far off the farm, is a phrase that we often use. The banking sector is going to be the underpinning of many of these economies, and I think a lot of countries are now taking on reforms to strengthen the banking sector. So Nigeria, for example, raised the capital requirements, which is the minimum amount of essentially cash that these banks need to hold to grow and be kind of viable lending institutions. And that's good and bad. The good is you'll have stronger banks. The bad news is you'll have probably a whole slew of mergers, acquisitions, maybe closings, maybe financial troubles as you kind of reform the financial sector. And Nigeria went through a very painful banking sector reform where there were mergers, which we saw as positive, but there were also banks that were going under, banks where the level of disclosure wasn't what was needed for kind of international standards. So I think that caused a certain amount of chaos, but the result of that has been a much stronger banking institution within Nigeria. So I think that's one thing, reform of the financial sector. I think you also need individuals within the government who recognize that an independent banking system and judiciary is going to be crucial. And that gets to, at the very heart of it, kind of democratic political reforms. And as you can see from what's going on in the United States, like political reform takes a very long time. It's a very slow process. And I think it's easy to look at maybe developed countries and say, okay, well, that should happen rather quickly. But if you look at the fact that many of these countries were, sovereign states only in the 70s and went through, periods of civil war, political crisis, kind of dictatorships, that you're really looking at maybe, in some cases, 10 to 20 years of democracy in some of these countries, and maybe for some, not quite that much. So I think this is a process that will take time to recognize that a banking system needs an independent authority. The central bank needs to be stronger, need to have independent governorships that aren't just simply at the beck and call of the political will du jour. And that we're seeing takes time, but it is coming in many countries. And as countries see entities like Nigeria and Senegal take those steps, I think we'll see other countries follow.